Yesterday, the crypto market witnessed a major altcoin sell-off, and we know one of the major contributors to the sell-off is the FTX asset liquidation news, but there's another major reason that no one's talking about. Also today, Bitcoin and altcoins experienced a short squeeze. Will Bitcoin fall from here or continue to squeeze? This is your Altcoin Buzz News. Hey, what's up everyone? My name is Cody Buffington. Make sure to like, subscribe, and turn on notifications so you know when I drop the latest content. Follow us on Twitter, AltcoinBuzzIO, and as always, this is not financial advice, and we wish you the best of luck in your crypto ventures. Do you know why Arbitrum is not part of Altcoin Buzz Alpha's secret portfolio? Arbitrum is one of the best available layer 2s, however, there currently is no use case for the token. It's not even used for gas fees or staking. In that case, we don't see much buy pressure for Arbitrum as of now. We just completed an Alpha community Q&A today and provided lots of insights similar to this question. Join Altcoin Buzz Alpha, link down below. Bitcoin rebounded off 3-month lows on September 12th as traders voiced suspicion over Bitcoin's price behavior. Bitcoin had seen immediate weakness on the previous day's Wall Street Open, briefly dipping below $25,000 to cap its worst performance since mid-June. The subsequent comeback took the largest cryptocurrency over $1,000 higher, past 26.3K. Ahead of time, on-chain monitoring resource Material Indicators warned that Bitcoin price would soon face a support test, thanks to bid liquidity further down in the order books being removed. Material Indicators and others noted that previous support rug pulls had ultimately produced Bitcoin market upside instead, with large volume traders clearing liquidity from immediately around spot price. Continuing, Material Indicators co-founder Keith Allen predicted that 24,750 would hold as support on the down move, and after the recovery, which he called a textbook short squeeze, trader skew was among those calling for bulls to overcome the $26,000 resistance. Data from monitoring resource CoinGlass showed a total Bitcoin short liquidations at just over $12 million for September 12th so far, while $71 million in Bitcoin longs suffered the day prior. I think more likely than not, this is just a short squeeze from everyone who is majorly short with the FTX news and altcoins dumping the last 2 days. I think it will most likely continue to the downside by the end of the week. But make sure to check out our TA video later with Randy, who will cover the Bitcoin levels to look out for, along with Ethereum, Rune, and Arbitrum. Institutions have fallen out of love with Ethereum in 2023, selling upwards of 9 digits of the asset in the year to date. According to the latest analysis by CoinShares, the number 2 cryptocurrency saw $4.8 million in outflows this past week, reaching $108 million in sales this year. That places it as the most sold digital asset by large entities. The analyst labeled it as the least loved digital asset for exchange-traded product investors. However, all that could change soon after Cathie Wood's ARK Invest applied for the first spot Ethereum ETF last week, the first of its kind in the United States. And that news comes after the network turned inflationary and on-chain activity plummeted as the grueling bear market carries on. According to CoinShares, sentiment regarding institutions purchasing crypto remains poor. The main reason behind the rampant selling is the US dollar. It's shown strength as of late, driven by the market's belief we are in a soft landing scenario, posting 8 straight weeks of green candles. CoinShares says, even so, it will increasingly be seen that this isn't the case, especially if high interest rates kick in. Although the previous report by CoinShares highlighted a bunch of under-the-surface trading, with volumes skyrocketing by 90% to 2.8 billion, this week's trading activity plummeted. Volumes are super low, averaging just 2.3 billion daily over the past month, compared to the yearly average of $7 billion. The last 7 days were even further from those numbers, dropping by 73% to $743 million. This suggests an apathetic investor, clarifying, however, that the market saw a very similar scenario prior to the 2 last Bitcoin halvings. Many investors are waiting to see what the Fed will do this month with interest rates, with any potential weakness in the dollar likely to be supportive for Bitcoin. I think with ETH as the leader of the altcoins, it's just a market that doesn't expect very much right now. Bitcoin spot ETFs are getting delayed all the time, so an ETH one doesn't seem likely. September is historically the worst month for crypto, and the FTX sell-offs are looming overhead, so it makes sense that investors may be just sitting on the sidelines. Arbitrum has emerged as a leading contender within the Ethereum network's Layer 2 scalability solutions, boasting a significant total value locked and notable activity. However, between September 9th and September 11th, the price of Arbitrum tokens experienced a sharp decline of 14.5%, marking its lowest point in history. Investors are now eagerly seeking insight into the factors driving this movement and questioning whether Arbitrum still possesses the competitive edge, especially considering that irrespective of the ARB token performance, the network TVL exceeds $1.6 billion. It is worth noting that the past week has been challenging for most cryptocurrencies, but among Ethereum scaling solutions, none experienced a drop exceeding 9% except for Arbitrum. Additional factors that may have helped contribute to the recent price downturn are associated with governance proposals from Arbitrum's decentralized autonomous organization. The first proposal, posted on September 2nd, aims to allocate up to 75 million ARB tokens from the project's treasury to address short-term community needs, for active decentralized applications within the ecosystem. However, even if approved, this allocation represents less than 2% of the DAO Treasury holdings and is unlikely to have triggered the ARB token price correction, regardless of one's stance on the proposal. There are also concerns related to liquidation risks on both centralized and decentralized exchanges that offer leveraged trading. For instance, Look On-Chain has observed a whale withdrawing ARB tokens from the Aave lending platform and transferring some to Binance. The challenge with this analysis lies in the ambiguity of cause and effect. Typically, leveraged long positions are compelled to close when token prices have already fallen, rather than the reverse. This underscores the importance of investors examining Arbitrum's activity and deposit trends over the past couple months, which could have potentially triggered the recent price performance. Arbitrum's TVL has notably declined to $1.67 billion, marking its lowest level since mid-February. This 25% decrease over the past 2 months raises several concerns, primarily indicating a loss of investor confidence. This downturn has the potential to reduce liquidity and undermine the project's overall viability. Furthermore, it might deter new participants, impeding network growth and adoption. There is a noticeable decline in 30-day active addresses, even among well-established dApps like Uniswap, 1inch, Radiant, and GMX. Therefore, when considering the decrease in TVL alongside reduced user activity, it becomes evident that there is a substantial decline in demand for the network. While pinpointing a singular cause for this movement is challenging, one can speculate that competing chains such as ZK Sync Era and Coinbase's Base may have contributed. The data suggests that Arbitrum's 14.5% correction appears to result from a combination of investors' dissatisfaction with the governance mechanism and the network's lackluster activity, despite offering significantly lower fees compared to Ethereum. Unless there is an upswing in transactions and an expansion of its user base, it's unlikely that ARB will be able to close the price performance gap with its competitors. The estate of bankrupt FTX has marshaled around $7 billion in assets, including $1.16 billion in Solana tokens and $560 million in Bitcoin, according to a Monday court filing. The presentation details billions in payments the company made to senior executives, including Sam Bankman-Fried, before it filed for bankruptcy in November. The company collapsed after CoinDesk published revelations concerning the state of its balance sheet last year, and the new CEO John J. Ray has berated financial controls at the company, while Bankman-Fried has pleaded not guilty to multiple fraud charges, with a trial due to start next month. The company has secured $1.5 billion in cash in addition to the $1.1 billion it held on November 11th, and also holds $3.4 billion in crypto as valued on August 31st. That's in addition to hundreds of millions of dollars worth of over 1,300 lesser known and potentially less liquid tokens, such as MAPS and Serum. The presentation also details $2.2 billion in cash, crypto, equity, and real estate received by Bankman-Fried, including Nisad Singh, Gary Wang, and Caroline Ellison in the months leading up to the bankruptcy. That may be significant because U.S. law allows such payments to be clawed back and added to the stock of assets that can be distributed to creditors. The filing also reports 38 condos, penthouses, and other properties in the Bahamas with an estimated value of around $200 million. The company's new management has attempted to reclaim funds made as donations to politicians and charitable organizations such as the Metropolitan Museum of Art in New York. FTX has asked a New York judge for permission to start selling off its crypto holdings so that it can return funds to creditors in cash. More than 75 potential bidders have been in contact with FTX over a potential reboot as the exchange seeks to pivot from its implosion last year. According to a notice, bidders for FTX 2.0 have been given until September 24th to decide on a revamp. FTX laid out its reorganization plans early last month, flagging a potential to settle creditors' claims in cash as part of the repayment process. The exchange reportedly owes $8.7 billion to more than 1 million customers. The real reason that altcoins were dumping yesterday, according to blockchain data, is that Jump Trading, Wintermute, and Abraxas Capital deposited large amounts of Bitcoin, Ether, and ARB to crypto exchanges during Monday's crypto market sell-off. Asset manager Abraxas Capital transferred 14,130 ETH, worth roughly $22.5 million, to Bitfinex in 2 transactions. Major market maker Jump Trading sent nearly 236 Bitcoin, worth $5.9 million, to Binance in 1 installment. Look On-Chain noted that Wintermute, another large market maker, deposited more than $3.3 million in ARB to Binance over the past 8 hours. Smaller traders tend to follow on-chain maneuvers of large institutional traders as they're considered well-informed and have significant sway over the market. Sending tokens to exchanges may signal intention to sell, but it can also be part of market makers shuffling funds between different exchanges to provide liquidity. Today's transfers happened as crypto markets turned down sharply on concerns about crypto exchange FTX potentially shedding its $3.4 billion in digital assets. September is historically a turbulent month for digital assets, with Bitcoin scoring negative returns every year since 2016. We also just posted a video on a high potential altcoin gem for the 2025 bull run, which you have to check out as well, linked down below. That's it for Altcoin Buzzy's update. I'm your host, Cody Buffington. Thanks for watching.